I got Jeff. Joe and Al, greetings from sunny Singapore. Singapore. Oh.
Have you ever been?
International program here. Global. No,
Right.
never been.
Me neither. My son's, Rob's been.
I've been out of the U.S. like twice.
Mexico?
Maybe 3 times. If you, yes.
Mexico, Canada, and
Yes.
What's the other one?
Yeah, I've been to Canada a couple times because I'm from Minnesota.
Bahamas?
Yeah, I've been to the Bahamas once when I went to when I was in Florida.
Yeah, sure.
And I went to London.
Oh, you went way across the
Out.
Atlantic.
Yes.
Look at that.
Yeah, I went to London for like a week.
Okay.
But that's about it.
I didn't know you're such an international traveler.
It's crazy, isn't it? My passport is out of control.
One step, maybe 2.
All right. I have a question regarding the stacking rule in the foreign earned income exclusion. Okay, so we got Jeff in Singapore earning some cash in Singapore. We can use the foreign earned income exclusion to exclude $108,700 of earned income. If this is all of our income, our AGI would be 0. Can we then go into our brokerage account and step up in basis $109,000 and be in the 0% tax bracket for long-term capital gain? Or does the foreign income exclusion get added back when harvesting gains? So let's stop there, and then I'll kind of explain a little bit of what he's talking about in regards to the foreign income exclusion. So we have clients that we're a big military base here, right, in San Diego.
Yes.
Navy and Marines, thank you for your service. And, we have spouses of those armed service individuals that might do some occupation in another country, such as, let's say, Japan.
Right.
Okay. And then there's this foreign income exclusion that basically could zero out someone's income.
Yeah, so here's what it is if you work in a foreign country, well, guess what? You're going to be taxed in that country's tax system. That's just the way it works. So what the U.S. has said is you can earn about $108,000 of W-2 earnings, salary, right? And we're not even going to count that on your U.S. return.
We're not going to tax it U.S.-wise. You're just going to pay whatever country that you're in taxes on their system up to that $108,000.
Yeah, and here's the mechanics. You actually do include the $108,000 on your U.S. return, but then you get a deduction. It's an adjustment to income, right, on your tax return. So the net effect is it zeroes out as long as it's $108,000 or below. If it's above that, well, then you got to pay tax in the U.S. as well as the other country, which then leads to a foreign tax credit. That's a whole nother story. But in this example, the question is this going to be added back for capital gain purposes? And so because what he's saying is he has about $108,000 of income that goes away from the exclusion. Can he sell about $100,000 of capital gains and pay no tax, stay in that 12% bracket? And the answer is yes, because the capital gain rate is based upon taxable income, right? If your taxable income is in the 12% bracket or lower, you don't pay any capital gains, long-term capital gains, for at least federal income tax purposes. So, yeah, there's no unusual, strange add back just for the long-term capital gain calculation.
So, again, this is another example of the capital gain sitting on top. Because you're zeroed your ordinary income out, capital gains would go on top of the ordinary income.
Right.
And then because he has zero ordinary income on his U.S. return, he can sell up to the top of the 12% federal tax bracket and pay zero capital gains on those stocks.
And it's a good question because there's a lot of confusion. Is the capital gain tax based upon your income, your adjusted gross income, or your taxable income? It's based upon your taxable income, which is already, your foreign income is already net against the foreign earned income exclusion.
He's got another. Excuse me. He's got another follow-up. If the answer is exclusions are added back in for determining taxes, is this? I should have read this, huh? Did we already answer this? Is this true for the sale of a home as well? That is, I know we can exclude up to $500,000 from a sale of our home. If we were to sell our home, assuming we now live in America and this is our primary residence, and wanted to also sell $25,000 of stock in our brokerage account, would the $500,000, assuming this was our gain, have to be stacked back and put this into a higher long-term capital gain bracket? Can you point me in information addressing these concepts? Kind regards, Jeff. So now he wants to sell his home. That's a 121 exclusion.
Yeah.
So you automatically get $250,000 or $500,000 excluded from taxes if you lived in the house 2 out of the last 5 years. So if he sold his house and sold the stock, you get the exclusion. He gets the foreign income exclusion, plus his taxable income is zero.
Right.
So he could sell up to the top of the 12% tax bracket and pay 0% tax
that's right.
there.
It's the same answer. There's no weird add back on the exclusion with regards to your sale of your home. There's no add back on the foreign earned income exclusion. It's just your taxable income. Start from there. And then if you end up at zero, then you can sell to the top of the 12% bracket. For a married couple, it's a little over 100,000. I'm just using 100,000 as the number. The reason I get that is because there's a standard deduction. So you can have more income than the top of the 12% bracket, which is about 83,000.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.